Okay, let's jump in. So picture this. You're maybe kind of new to investing, right?
Hmm.
You've bought a stock and hey, congratulations. It's actually doing great. It's trending up. You're making money.
Yeah, that's a fantastic problem to have.
That
Seriously.
totally. But almost immediately, especially if you're just starting out, it brings up this big question. What do you actually do next?
That was
Like specifically, does it make sense to buy more of that same stock even though the price is higher now than when you first bought it?
Yeah, that's a super common question. We hear that a lot from people figuring things out.
Mm-hmm.
And we looked at this source document. It's called Buying High.
Okay.
And it tackles exactly that scenario. It explores that question, but also lays out some other strategies to think about. Maybe things besides just doubling down.
Perfect. So our mission here for this deep dive is basically to unpack what that buying high source suggests you might do when one of your investments is, already on the upswing.
Exactly. And look, the document isn't saying definitely don't buy more. Not at all.
Right.
But it does highlight that buying more when it's already gone up, buying into strength, isn't the only move. And maybe not always the best move, especially early on. So it offers alternatives.
Okay. So what's the first alternative it talks about?
Well, the first one is something called partial profit taking and rebalancing.
Interesting. So kind of the opposite of buying more.
Yeah, exactly. The idea here is you actually sell some of the shares you own because they've done well.
Okay. And why would you do that? The source gives a reason.
It does, and points out that this helps you lock in some of those gains you've already made on paper.
Oh.
So you still keep some shares,
Right.
right? You can still benefit if it keeps going up, but you take a bit of money off the table. And that reduces how much your total pot is tied up in that one single stock.
Right. That makes sense. It's managing your exposure, your risk, even on a winner.
Precisely. It acknowledges the success, but, keeps things in check a bit.
Yeah.
Okay, so the second alternative the source mentions is putting new money into other opportunities instead.
So not selling the winner necessarily, but if you have new cash to invest,
Exactly.
you put it somewhere else, not into the stock that's already gone up.
That's the idea.
Yeah.
And this gets into diversification, which the document really emphasizes.
Right. Not putting all your eggs in one basket.
You got it. Instead of concentrating even more of your money in that one successful spot, which increases something called concentration risk,
Mm-hmm.
you spread new funds around,
Mm-hmm.
different companies, maybe even different types of investments altogether.
Which feels especially important if you're just building your first portfolio, right? You don't want one lucky pick to accidentally make your whole setup too risky.
Absolutely. It's foundational stuff.
Yeah.
Okay, then there's a third approach mentioned in the source. Basically, no action.
Mm-hmm.
Or, simply
Holding.
holding tight, doing nothing.
Sometimes, yeah. Doing nothing can be a perfectly good strategy. The source suggests that, look, if your original reasons for buying that stock are still solid,
And you genuinely believe the company, or maybe the market it's in, still has significant room to grow, then just holding on to what you've got and letting that initial investment keep working can be the right call.
it feels a bit counterintuitive, doesn't it? You see green numbers, you want to do something.
Totally. But the source says staying put is valid if your confidence is still high based on, your actual analysis, not just the recent price jump.
Okay. Now, buying high also talks about the math, right? If you do decide to buy more shares at a higher price, it mentions weighted averaging.
Yeah, this is more about just understanding your own numbers, your performance tracking.
How so?
Well, if you buy more shares and they cost more than your first batch, it mathematically pulls up your overall average cost per share for that specific investment.
Right.
Your new average cost is just, the total amount you spent divided by the total number of shares you now own.
Okay, so your example, if you bought 10 shares at $10, spent $100, then 10 more at $15, spent $150, your total spend is $250 on 20 shares. So your average cost isn't $10 anymore. It's $250 divided by 20. $12.50 per share.
Exactly. And the source just points out this isn't necessarily good or bad. It just is. It changes the baseline that you're measuring your future gains or losses against for that stock. Just something to be aware of.
Got it. Okay, so just to recap quickly, we've talked about taking some profits off the table, using new money for other investments to diversify, just holding on if your thesis is strong, and understanding how buying more raises your average cost. All these ideas coming from that buying high source.
That's right. And maybe the most crucial takeaway from the document, really, is that there's no single right answer here, not one that fits everybody.
Right.
What you choose to do, the best move for you, well, it really has to line up with your own specific financial goals, how much risk you're actually comfortable taking on right now, especially as a beginner, and, your own honest view on where that stock or the market might be headed next.
Which I guess is why the source brings up talking to a financial advisor.
Exactly. It mentions that as a good step because they can help you take these general ideas and sort of tailor them to your specific personal situation.
Makes sense.
So maybe a final thought for you, the listener, to mull over. Given these different paths, tweaking your winning position, branching out, staying putting by, what parts of your own financial picture, your own comfort levels, feel most important when deciding what to do next with an investment that's gone up? Something to think about as you keep learning and building your approach.